So without further ado, I'd like to welcome everybody to the offering webinar for this evening of Belltown developers. Thank you so much for joining and giving us a few minutes to evaluate this investment in Belltown developers, the purchasing entity of the apartment known as Edwards on Fifth. We will walk through the investment strategy, which will include how we intend to structure the debt and equity, manage the assets, why we're so bullish on the Seattle market, and the multifamily asset class and everything in between. First, I do want to make mention of a few important disclaimers. First and foremost, we are not offering any legal or tax advice, nor are we attorneys, accountants, or CPAs, so please do your own due diligence. We do have all of our documents that we perform the due diligence on in our underwriting folder that is in our investor portal. So please encourage everybody to get out there, do your own due diligence. This is just an overview. Now that we've got that out of the way, I do want to share how to access the investor portal. The data room does contain, like I said, the full underwriting file as well as all the due diligence files. The data room can be accessed by logging into the investor portal at the top right corner of gold-mf.com. You'll register your account, sign in, and from there, follow the prompts to learn more about the deal. And when you are ready, you can schedule a call with me or move forward in placing your investment there. So what I want to talk about real quick is the investment at a high level. So a few highlights that we'll discuss throughout the webinar is really, truly, real estate is all about location. And this one takes the cake. AAA location, a block away from the Space Needle. And we'll get into a lot more about the neighborhood itself. Value add opportunity through really operational improvements and modest increases in rent. This opportunity, this investment does not hinge on increasing rents a substantial amount. It really truly is an operational improvement plan. With strong seller financing terms, we will be able to cash flow truly within the first year and in the first quarter, as well as several market-based factors like strong rental demand and growth, as well as unbeatable tenant grade. Now, what I want to talk a little bit about right now is the leadership team. The leadership for Belltown Developers is made up between Augustus Bukowski, Dominic Wood, and myself, Carl Krauskopf. Augie for short, and Dom for short, and I have worked together in various capacities over the last 3 years. Most relevant, most recently, is the experience of purchasing the last 2 apartment complexes, a 30-unit garden-style apartment and a 12-unit walk-up that were both constructed in the 1920s. So why is that important? It's important because we know and we know how to operate older buildings, despite this building, Edwards on Fifth, having all updated systems. We'll talk about that later in the presentation. Now, one real key important piece to this business plan as well is who we're going to be working with. So Gold MF, we're going to be working with property managers in the market that have been in place for over a decade. What we are going to be doing, our responsibility is setting the strategic direction, sale and repositioning and redevelopment of the asset while working with the property management company in order to manage the tenants, manage the actual maintenance, the regulatory aspect, and executing on the strategy. So again, a strong relationship with our property management company is pivotal. And we are thrilled to say that we have great relationship with both of these property managers, and we are going to be moving forward with one of them. So what I want to pull back to the macro level for just a few minutes. I'll pass it over to Augie, and Augie will discuss the asset type, why the region is one of the strongest in the nation, as well as followed by a deeper dive on the neighborhood. And finally, we'll get into the asset and the business plan itself. So Augie, go ahead.
All right, guys, my name's Augie. Welcome, and I'll talk a little bit about multifamily in general. One of the reasons why people like multifamily in particular to invest in is it is quite stable versus other asset classes. What you're looking at here is the average return. You'll notice it's in line or higher than most of the other investments over time, looking at hotel, industrial, retail, office, or the S&P. And then more importantly, back to the quality of that product, the standard deviation is the lowest. So what that means is that there's lower volatility in this price point. So when you put money in, you're going to have less flexing of your money going up or down. It stays around that average return, which again makes multifamily real well. If you look over history, multifamily continues its growth. It has a little bit more stability, and that has continued to increase over time, where some of the other asset classes have actually dipped off, such as retail. I'm sure we'll see office kind of dip down here over the next couple of years, and hotel. But the bottom line is people need places to live. They tend to live there. And so we see a lot more resilience in the multifamily market space. There's another problem coming on the market, which is basically the economics of building multifamily is very difficult. The cost to actually build, the cost of the construction financing to build exceeds the economic viability of projects. So what you've seen that people have actually slowed or halted some of their supply. And so that will further restrict the amount of units available. You can see here that the actual supply coming to the market is down significantly over where it was trending over the last decade. I believe that we're going to see more of that, which will increase demand for housing, especially at a time where home affordability has reached an all-time low. If you are trying to buy a home right now, realistically, you can't buy in the location you want. You can't get the size of property you need. And so what we're finding is that people are faced with a hard decision of relocate, which they don't want to do, or buy a property that doesn't work for them, which they don't want to do and pay a high payment, or choose an alternative option such as renting that allows them to get what they want or location they want. And then in this particular play, get something that's affordable where they can save money and continue going towards that homeownership goal. So you can kind of see that permits were cruising on up via 2020, 2021, while we had cheap financing. It made apartment and multifamily development look much more favorable. What you've seen is that's tapered down. In fact, a lot of those projects have been put on hold, as we discussed, and they will not come to the market for a while until those economic factors come back. You will see that some people have basically halted, but there are other builders who have seen the same trends that we are, especially in Belltown itself, who are now seeing the writing on the wall that over this next 5 to 10 year period, as people are forced to rent, as employers such as Microsoft, Amazon, et cetera, have return to office policies, we should see that rental demand pick up. There's going to be continued pressure on rents, which will increase those rents, and these projects are becoming more economically viable by the day. So what you can see is that Seattle has had positive rent growth month over month, continue to grow. Seattle is actually one of the fastest growing major cities in America. Just over the last 12 months, we were at a 2.4% growth rate, which is the top of all major US cities. People are continuing to move here, and as the return to office mandates continue to be prevalent in the workforce, we do anticipate to continue to see that growth here, especially with all the diversified industry that is here. You can kind of see one of the reasons why people are going to have to rent in our market versus other markets. This is illustrating the median home price versus the population's household income. And what you'll see is that based on our population, that the median home price doesn't really work for a lot of folks. And so we're going to have a lot of people that are renting. They are held out of the home ownership space. And for that, we should continue to see further pressure on multifamily, which is one of the reasons why we're so bullish on investing in multifamily at this time. Seattle also has a very low vacancy in general, but what I want to illustrate with this particular slide is the vacancy for this property type. What you'll see is that we're looking at buildings that were built prior to 1990, buildings that were built 1990 to 2010, and then 2010 to current. What this is showing is kind of like a mid-age home versus a old age home versus new construction. And what you'll see is that the vacancy is actually very low on older inventory. The reason for that is it's more affordable. We're talking about a housing affordability crisis, and these particular older buildings you typically get a larger footprint for a cheaper price. People are moving towards that more affordable option because everything else has gotten more expensive as well. And these buildings actually trend very well with low occupancy or with very minimal vacancy. The other thing that we wanted to track is, I don't know how much you guys know about multifamily in general, but multifamily or any investment that provides net operating income is valued based off of what's called cap rate. So what we wanted to do here is we wanted to provide you a snapshot of cap rates historically. So going back to 2017, you'll notice that the cap rate is never actually over 5%. Right now in Q2 2023, that cap rate is about 4.9%. The reason why this is important is because if you look historically, even back to 2007, when the market had the financial crisis, cap rates barely flirted with the projected cap rate that we're using to value this building. We're currently projecting this property at just under 5.5% cap rate, which leaves us a lot of room for cap rates to actually compress below that, increasing the value of our property once we finally get ready to sell it. So we talked a little bit briefly about employment landscape. It's one thing to just say that we have tech here, but the reality is we have aerospace, we have tech, we have Costco, we have Starbucks, we have some of the world's, so many of the world's most billionaires. We have billion-dollar companies, we have headquarters here, and they're diversified across a large landscape. Not only do we have those employers and that employment opportunity, but we also have all the ancillary jobs that work for them. So for instance, contractors, construction, etc. And so we have a very diversified workforce. So even if we were to lose one industry or have issues somewhere, for instance, you guys heard that tech has been doing layoffs, things like that, other jobs have come in and filled those voids, and we continue to have growth in our income, which has allowed for those rents and prices to continue to increase and the market to be very stable over that period. Amazon, again, touch base, return to work. They're obviously one of the biggest employers in America, headquartered here. They've basically mandated that you will come to office or not work. Additionally, they are still growing downtown. There are multiple people that are working with them. And this property in particular is located very close to their headquarters. So as people might have to return to work for part-time or a couple days a week, this might be a great option for them to come live in the city while also still doing other living spaces outside of the city if they want a bigger property. So downtown Seattle, we have seen more growth there, more travel there. We have seen vacancies going down, demand for hotel rooms and stays coming up as business travel comes back, as people begin traveling more to Seattle as we're continuing to grow. And the occupancy in apartments has risen as all the ancillary businesses in these neighborhood commercial spaces have started to come back in. So we've seen a record number of visitors in July 2023 downtown, and we're going to continue to see trends like this as we continue to thrive and grow. Hotel revenue's up. We've had just a lot of visits. Crime is actually on the decline. Carl is actually working with the neighborhood councils that he'll talk to you about a little bit later. And they've been doing lots of improvements, particularly in Belltown, to help people feel more safe and also come into that area. As obviously there has been crime in Seattle. The recent changes in the council, et cetera, are leaning towards more work they're implementing in the city to make sure that it is a safer area for most folks to live and try to get people back down into downtown and make it a thriving part of our city. So neighborhood, Belltown, this is where people want to live. When I've invested in real estate in general, we want to live in what's called a neighborhood commercial center. That would be like an example of Phinney Ridge, Ballard, Capitol Hill. These are neighborhoods that are thriving with amenity. People do not like to have to commute. They don't want to have to go find parking and go to a different destination. They want to be able to walk outside their door and get great coffee. Right next door to this property is Pho Viet An, one of my favorite Vietnamese restaurants here in the city. Located right here at the Denny Triangle, you have the Seattle Center, you have South Lake Union, you have Belltown. These are areas rich in diversity, rich in culture, rich in food, rich in amenity. This is the type of place that people want to live. And if we can provide them an affordable option there, they're going to pursue this as opposed to a location further out from the city. As we mentioned, it's in the Denny Triangle. It's important to understand that people in this area are quite well off. We're not looking at a low quality tenant base. The median household income here is $135,000. That person that makes $135,000 probably could not afford a home in this location, even if it were a more affordable condo. However, they can't afford the median rent. The median rent in this area is about $2,200, which is actually significantly higher than our average rent. We're averaging about $1,460 per month, or sorry, $1,360 per month on the units. You'll notice that that is a very affordable level versus the median rent. So we have a high occupancy at this location because we're providing such a good amenity-rich, affordable product in that market. You'll see that because the trends that we talked about earlier, some of the developers who had put a pause to their supply are coming back because they're seeing the same economics. Rents are starting to pick up, and that area is becoming much better and more qualified to invest in. So in summary, Belltown is thriving. I live up in Edmonds. Edmonds is a population of about 40,000. Belltown, which is a small little neighborhood in Seattle, has 21,000 people. That's very well established. It is young professionals averaging about 34 years in age. As we mentioned, they make about $137,000 per year, which is a little bit low to get housing in that area, but works great for rent. And this is what's important is the income to rent ratio is 6.83%. That means that the person who is renting our properties is not living paycheck to paycheck. They actually have ample income to make sure they pay their rent, which is why we've seen very stable cash flows on this building. And they have an average credit score of 716. That's a very well qualified client. If they were coming into me for mortgage services or lending, they would be considered a paper buyers. Touch briefly, not only do we have all of this set up where it's a great opportunity where we have high A-class tenants in a high A-plus area that we have negotiated a favorable price on at under $170,000 per unit. It's actually one of the best per unit costs that I've seen. But we then took that a step further and layered on top of that investment seller financing. A lot of people use seller financing to try to justify a price that doesn't make sense for the market. And because they got good financial terms, they are able to then try to get someone to pay more for their property. In this case, we got the right price on the property based on its actual financial economics and layer on seller financing. In this particular transaction, we're able to negotiate a great financing term, which is 5 years at 5% interest only. That payment is only $13,500 per month. And this building is a 33 unit that spins off over $45,000 in just gross rent, not including all the ancillary revenue. That is one of the reasons why we're able to deliver cash flow and disbursements in year one and why we're so attracted to this property. In fact, it's important to say that if you're out there trying to buy a rental property, if you're out there trying to build something to sell, or if you're trying to buy some ancillary investment right now, it is very hard to get it to pencil and make cash flow. So even though we're all aware and why we're here and investing in real estate is we believe that that price will be higher in the future, it's very hard to find something that will work while we ride out the storm. And this particular asset being undervalued and cash flowing with immediate rental rate upside makes for a very good opportunity to place your money while the market is a little bit funky while we're dealing with the inflation crisis.
Excellent. Thank you so much, Augie. I appreciate that. Great feedback and great insight on it. Real quick, Dominic, I want to pass it over to you. Talk about the customer experience and how we're going to be curating a boutique experience for our residential tenants, our commercial customers, and again, how we're going to be able to curate that boutique environment, boutique experience for those tenants.
Awesome. Thanks, Carl. And thanks, Augie. So quick review of the property. As you guys know, it's a 30 unit plus a 3 retail unit, a mixed use building. The 30 units of the tenants are fully occupied, and these are not discounted units. So we have, as Augie said, almost peak rental rates for these. And the benefit of the current building is that we have opportunities to reduce the expenses and increase the value of the property. The 3 retail spaces encompasses a bridal store for bridal gowns, as well as a European tailor that kind of goes hand in hand with that unit, with the corresponding unit. And then we have a 1 vacant retail space that we have an opportunity to do some upkeep there and find a really great new tenant. So that's an area that we will, and our expertise will come in and work on that particular space to increase the rent there. They had a low rent tenant in there previously, and we have an opportunity to increase the rents there. There is a shared laundry in the building that also will increase some revenue with that. And we also have a basement. The basement has multiple storage units that are not being utilized. So there's opportunities to rent the storage units. And there's also a large area for building out a office space. So we would like to offer for those that are working from home an opportunity to come down to a more private office professional area where they can do their work and be outside of their unit and get a little bit more room to make calls and work outside of their unit. From there, the building current management has done a really nice job of upkeeping with the building. So all of the units have been updated. So they all have LVP flooring, new cabinets, new updated bathrooms. So when it comes to doing the turnover for each of the units, luckily we don't have to do a lot of improvement for those. So very, very minor stuff that we would need to do. So when it comes to the expenses that we are going to have for savings for the updates of the building, it's going to be pretty minimal. Another thing that we have an opportunity to do with the renegotiation of the current retail spaces is move their updated leases to a triple net lease so that they are covering some more of the expenses. One thing that Carl and I have done at the building is go through a very detailed inspection. So we brought out a roofer, we brought out the inspector for the elevator, we walked inside every single one of the units and inspected every single unit, and made sure that we made notes so that we could address any issues that any of the tenants have. One part of our agreement with the seller is that they are required, as part of our feasibility, to make any repairs that came up during that inspection. So when we get the building after closing, it will be in almost perfect condition. So there is some areas for improvements, but overall, the current management's done a very good job of upkeeping the building. And as Carl said, all of the utilities and things like that have been updated, I believe, in 2005. Is that correct?
2008.
2008. Thank you. So very, very little turnover in the short term. We have 1 retail vacancy, as I said, and we are in the process of evicting 1 tenant that's a Section 8 housing. That's the only Section 8 housing tenant that we have in there. So when it comes to the quality of the current tenants, 99% are very high quality, and the one that we that is a Section 8 tenant, the current management's in process of evicting that tenant. So that should not be an issue going forward. With that, I'm going to hand it back to Carl.
Thanks, Dom. And while I cycle through some of the exterior photos, one thing to mention is on the renovations on the interior units, really that's going to be limited to aesthetics. So going into the kitchen cabinets and adding in hardware, minor things like that. So as you can see, the location of the asset, the location of Edwards on 5th is in an absolutely prime spot, a block away from the Space Needle. We're right near the metro line, and again, walking distance to any of the amenities, restaurants, bars, office space, entertainment that somebody could even dream of. The exterior photos of the building, exterior is absolutely gorgeous. So you've got a walk-up brick facade on the front, painted concrete on the backside. The commercial space is ground floor here. A couple images of the the commercial tenants. The Christina's Bridal is actually has a quite a decent online social presence. So again, that what that means and what that spells to us is an anchored product or an anchored tenant, one that has been there for the last 6 years, and one that we would like to stay for another 6 years as well. In getting into the floor plans of the residential, so these are like Augie mentioned on the front end, large studio units, and the floor plan of each one, wide open, a big space. We're offering super affordable, right? Where you're looking at $1,600 rent for 150 square feet on some of the new Class A apartments. We're offering something that's more than twice the space for quite a bit of a discount. So again, this is going to be a perfect product for the folks that are coming in, wanting to move into the market, test where they want to live, and stay, typically 2 to 3 years from an average tenancy standpoint. Each of the units will have views of the Space Needle, the Olympic Mountains, the Puget Sound, downtown views. So everything in here, again, has been updated from a systems perspective and is quite amenitized. The interior photos of the residential, we'll just buzz through these. The bottom left photo is going to be that space in the basement that we're going to be converting into a communal workspace. Again, picture Zen booths, photo booths, soundproof booths where someone can go in and hold a meeting without any interruptions. The entrance to the space is secured behind secured doors. There's also an intercom that people on the ground floor can buzz up, and that goes actually direct to tenants' cell phones, which is a great amenity as well. The interior photos, as Dominic had mentioned, are all updated already. LVP double pane vinyl windows. One digital asset, I should say, that comes with the acquisition is going to be Dollhouse and 3D floor plans, which helps expedite the lease-up process. And the photos that I'm putting up now truly are indicative of every single unit that we saw that we got to walk in. And here's a lovely view of the Space Needle from one of the tenant spaces. Talking about the operational plan here. So year one really is going to be getting in and optimizing the operation. So meeting with and making sure that we are getting in, cutting unnecessary costs. For example, we've got the existing management is utilizing external monitoring services for one camera, cost is $1,000 per month. Now, what we're going to do is we're going to go replace those with cheap, effective Ring cameras, and the value that we're going to see, which is great, we're going to see some additional cash flow from that, right? The $1,000 per month in reduced expense from a monitoring service perspective. However, the big value there is what that's going to do for us on the back end. So if we take $1,000 per month out of the operating budget at a 5.4 cap rate, which is where we're projecting the exit to be, that spells about a $225,000 value bump on the back end. Now, that is the simplest and lowest hanging fruit. There are dozens more examples that we'll get into momentarily. So again, the big play here is going to be right sizing the operations for the assets for this particular apartment. We'll be going in and we'll be increasing rents nominally, right? We're going to be, of course, going in on every unit turn, start optimizing the rent. But the beauty of this business plan is that it doesn't hinge on 10% immediate bumps, right? We're looking at 3% annually, which is keeping up with inflation. And as Augie had alluded to earlier in the presentation, there are much larger developers in the space that are putting a lot more money into this market, into the submarket, betting on the facts or betting on the idea that Belltown specifically is going to see radically higher rental demand and rent increases. Year 3 and 4, we'll be exploring the exit, and from an exit perspective, it really is going to be selling primarily. We've got options for refinancing as well. One important thing is that year 4 is our projected exit. We do have the existing term is for a 5-year loan with the seller financing. We are working on obtaining extension options as well. quick view, we already touched on this extensively early in the presentation. We are going to be targeting ourselves as the competitive, affordable offering in the market. And again, this business plan does not hinge on pushing and getting to the top of the market, testing out boundaries, getting above where we need to be from a market rate perspective. And so again, we're looking at nominal annual increases. Talking about the actual financial offering for a minute, let's shift gears into that. The investment breakdown itself, our total raise is $2,750,000. Limited partnership. Limited partner is going to own a 70% stake in the company. General partnership would be a 30% stake in the company. Minimum investment at this point is $100,000. Exit plan is 4 years. Now, our closing date is scheduled for October 20th, and we are marching towards that. And I believe that we are slotted to close on time. And we are thrilled about it. So that way we, again, can take over ownership and begin making those cost cuts immediately. From a projected return perspective, cash on cash right now is just at 7%. Average annual return 19%, and internal rate of return is 16%, equating to an equity multiple of just under 2x, so at 1.76. And this is for Class A investment. If you are looking for, and if you have additional capital, Class B shares are available. Essentially what that comes with is a 10% premium over the Class A equity. So if you are in a position and the Class B shares are $500,000 each, if you are in a position and if you're interested in that, please reach out to one of us directly and we'll give you a much more detailed analysis of what that looks like. From a sources and uses table perspective, want to run through this real quick. Total sources, just over $6.25 million made up between the seller carried debt and the total equity. The acquisition price, just under 5.6. We'll run down through the uses below that. Between the renovation reserves of $270,000 and the operating reserves of $186,000, we'll have just under $500,000 of post-close liquidity. What that means is we're going to have nearly $500,000 to deploy should we need to. Now, what we will be doing with that capital in the meantime is putting those into high interest savings money market accounts, where again, the interest that comes from that is going to be passed directly dollar for dollar back over to the limited partnership. Legal fees, closing costs, and our sponsor fee. Sponsor fee is 2% of the acquisition price, and that is the essentially the broker fee as well as the project management stabilization fee as well. All right, so let's dive into the income, the operating expense analysis as well. So first, we'll look at the seller actuals, then we'll look at our projected income analysis, followed by the seller's actuals on the operating expenses and our operating expenses. So let's look at this right now. As Augie mentioned, we're at $1,300 on the average residential rent. Our other, which is comprised of things like laundry, parking, utility bill backs, etc., is $136 on average. Now, this commercial rent does include the one vacancy, so we will see what that's going to turn out to be. But right now, the asset is operating on about $570,000 run rate in terms of income perspective. So let's look at our analysis of what we intend to, and what we expect to be able to take. So year one, we don't expect to increase the residential rent $1. And obviously we will pursue that on any new lease ups. We will pursue higher leases, higher rent on new leases. And we will also be pursuing the rent increases on same store or same leases. But again, it's not underwritten from a requirement standpoint. The other residential income will not be increased. The commercial income is going to be the one that is going to be changing. So this is assuming we place the one tenant. Year two is going to be the inclusion of the triple net lease. Dominic had mentioned that earlier in the presentation, and you'll see at the top of the year two for the residential rent of where we're going to be taking that. Again, that's a little over 3% per year. So that annual rent escalator is going to be baked into the commercial leases. Seller actuals. Let's look at this. And again, this is the big play. This is the big value add play that we're looking at. So from a admin perspective, we're going to be bringing down a substantial amount of expenses there. And again, the story here is that we're buying from a large operator who is running this 33 unit similar to their other 600 unit complexes, right? And so they're running it as an institutional asset, which is great for us for a few reasons. A, it means they're maintaining the property very well, as Dominic had alluded to earlier. It also means that they care about their reputation. And so nothing they're going to care about this transaction. They're going to care that it's done well and that their reputation on the back end of it is upheld. So again, we are in a great position to take this apartment, right size it, put in an operational business plan that's relevant to the size that it is, and then be able to collect the cash flow during the hold period and resell it with a right-sized net operating income on the back end. So again, what I highlighted here were several of the areas that we believe will be an easy target in terms of reducing expenses. Our operating expense analysis, targeted vendor contracts. So we will be targeting a slow reduction in vendor contracts over the course of the hold period. Our real estate taxes, this is just highlighting that half of the taxes are paid at closing. Payroll reduction on the back half of our hold period. This is going to be indicative of a stabilized product. And as we go in, as we make those renovations, those small unit turns, what we'll be doing is adding in low flow and high efficiency utility fixtures. Looking at the debt and cash flow analysis, to start off in year one, what is not highlighted is we expect to be performing at a 6.1% cap rate on the back and within the first year. Now, why is that important? Because we are operating on a 5% interest only payment. So 6.1 cap rate compared to a 5% interest only debt service payment. What that spells is big cash flow within year one and continuing to grow through the hold period. Our exit performance cap at 8%. Full term interest only, as we mentioned. No preferred return deficiency. So everything is being paid out within the year that it's owed back over to the limited partnership. And what that spells, bottom line, is in-year cash on cash is incredible. Starting at 5.4% within the first year projected, and ramping up to 8.1% cash on cash return by the end of the hold period. This is fantastic. I'm personally excited about it because I think that this is going to be an incredible cash cow. Let's look at a hypothetical member return analysis, assuming a $250,000 investment. What I'll highlight here is the in-year cash flow. Year one would be projecting at just under 13,500 from a cash flow perspective in year one, ramping up to just over $20,000 in the fourth year, equating to about a 7% average cash on cash return. Equity multiple 1.76. So again, these returns are fantastic from a cash on cash perspective. We're going to be buying this incredible income producing assets with great upside on the back end. Exit valuation cap rate analysis, as Augie had mentioned, will be projecting at a 5.4. So this is right at where the great financial crisis back in 2007 to 2012, where those cap rates were flirting with. Our exit price, just under $8.5 million. Since there is no prepayment penalty, our sale cost is about 6%. Net proceeds from the sale is nearly $1.9 million. And what that means is the limited partner share would be getting just over $1.3 million on the back end. So let's talk about next steps. Next steps are pretty simple, right? Make a commitment to action. Access the investor portal. We walked through that earlier. There you'll be able to learn more about the deal itself. Once you are committed to moving forward, again, we are more than happy to have that conversation with you. You are able to sign the documents. It is a self-serve portal. And there you can, again, sign any necessary documents, follow the prompts, and you can complete your investment all within the portal itself. That concludes the scheduled presentation materials. Again, I really appreciate everybody's time on this call. We do have quite some time, a couple minutes actually, for question and answer. There is a Q&A function that would be the way to access. And Augie, if you wouldn't mind, if we've got any questions there, would you mind start reading those? Otherwise, I did have a couple that came in via email. All right, Augie, I can't hear you yet, but let me get this one. One that came over from email last night answered, was asking about the cash, the liquidity. What's the best way to invest? Obviously, that depends on the investor themselves. Since we are not CPAs, we can't tell you what's the best. Obviously, from a cash perspective, there is some value there in terms of depreciation, depending on if you are a real estate professional. You would be able to utilize all of that. Otherwise, you can use depreciation to offset things like cash flow, other capital gains events, whether it's the sale of stocks or whatever it happens to be. IRA, if you are interested in investing via a retirement account, those would be things like rollover IRAs. We do have a custodian that we've worked with multiple times in the past that we'd be happy to make an introduction to. That process does take a little bit longer, usually about a week and a half. So if an IRA, self-directed IRA, is something that you would be interested in, it is something that you would have to work on. We'd have to get you plugged in pretty quickly.
There are no new questions, but if anyone has any questions at this time, please do ask them. Multifamily market, this project, there is an open Q&A at the bottom of the screen, and you can click that link and ask any question that you might have.
Hey, Augie, if you wouldn't mind, can you give us a little bit more in terms of your history, your experience? Would you mind sharing maybe about a 30-second clip of your experience in the multifamily in the Seattle market personally, in terms of personal investments?
Absolutely. So I love the Seattle market more than almost any market out there because my tenants are very high quality, and basically I can set it and forget it. So over the past decade and a half, I have done everything from build luxury houses to townhome multifamily units, 10 to 50 unit apartment complexes, owned and operated, and done value add investing on small to mid-sized multifamily. And I think that this is an absolutely great place to be focused because big hedge funds or big fund managers, they need to get big 100-unit buildings in order to deploy their capital. Where us as a smaller, nimble syndication company can go target and acquire these properties at 20 to 50 units that are not being looked at by the hedge funds and actually operate much better. So for instance, if you see the properties that hedge funds are buying, they're typically trading at $350,000 to $400,000 a unit. We're getting this property for half of that. So we're operating their exact same game plan on higher cash flowing assets. It's been very easy to acquire properties. Typically, what we do is we'll acquire the property, put in a very easy to follow strategy, whether that's reducing cost expenses, stabilizing that asset from an expense standpoint, and then doing minimal updates to make it feel more like the market. What I mean by that, things like cabinet hardware, paint, different color schemes, things like that are actually cheap to do, that we can do as units turn and use cash flow to do, or our renovation budget to do. And then increasing that to the market by being a little bit more dedicated to how we're actually going to advertise this property, the level of commitment that we're going to work with guide services or peak in order to actually get tenants in. And we've had zero problem filling up properties. I just got done renovating a 7-unit apartment building over in West Seattle. And we renovated 4 units at once. All the tenants vacated, no issues. We had 2 Section 8 tenants in that one. They vacated the property, no problem. We went in, renovated all of the surfaces, and then released those properties out for double the initial rent. It has been a fantastic experience, and I have a check that comes into my account every single month from each tenant. And in particular, with this particular financing strategy, having that cash flow come in is great.
That's great. I appreciate that. And Dom, while we're waiting on another question, if you wouldn't mind, I'd love to hear a little bit more. I'd love for you to share a little bit more about your experience in the short-term rental and, again, creating that boutique experience for tenants and guests and how that would be relevant to our apartment complex.
Sure, no problem. Thanks. So over the last couple of years, well, over the last decade, I've been building, remodeling, flipping homes, and over the last couple of years, converting many of my properties into vacation homes and short-term rentals. My goal has always been to maximize the cash flow and revenue of those properties. And in the process of doing that, our goal is always to make our homes very luxury and stand out in the market. And so utilizing artists, bringing in fine artwork, and separating our homes visually from the others. This is the same type of thing that we can do in an older building like this, by refreshing the retail spaces as well as the basement to just provide further higher end quality for our tenants and our retail tenants. My background initially was in property management. I did work for a very large real estate developer on Eastlake and managed those hit their buildings on Eastlake, and that included a 20 and a 30 unit building plus retail spaces plus restaurants. So my role with them was to increase the rents, manage the day-to-day operations, and assist with marketing for those retail clients. So we'll just be utilizing our experience with that, and with a goal to make this building as beautiful as it possibly can be so that we can continue to get a high quality tenant and increase the rents as necessary. But I think one other thing, Carl, I don't know if we mentioned this, but one idea as far as the retail space is looking for either a nice coffee shop. My family's pretty heavy in the coffee space. We sell espresso machines around the world, so we're pretty networked really well in the coffee arena. So we will likely look for that type of a tenant that doesn't require kitchen equipment or any heavy equipment or changing of the space, things that can be very easy to do inside the retail space. Fresh paint, putting in new flooring, and just making that space look really cool and attractive for other people that are walking by to come in and see our nice new building.
Great. Thanks, Tom. I know one thing that comes to mind is safety and security, investing in Seattle, crime. One thing that, Augie, I'd love to get your take on it, but before I pass it over to you, is one thing that I am personally passionate about is, while I would not say I'm an activist by any means necessary, I am certainly an activist in the sense that I am active in protecting my business, my personal interests, the interest of my clients. And so one of the things that I am personally doing is joining what's called the Belltown United. Belltown United is a committee, nonprofit committee that is owned and operated by local business owners in the Belltown neighborhood. And the common goal is to unite business owners within the Belltown and surrounding neighborhood, and and come up with ideas and put into practice ways to reduce crime, right? This is property crime, this is crime against people. And one of the things that I'm personally going to be doing is taking an active role on that committee and ensuring that we as a management team are doing what we can to make the neighborhood a better place to live, a better place to live for our tenants, a better place to live for our the buyer who we're going to be working with in 3 to 4 years. And again, improving the overall neighborhood, so that way, again, we have a more predictable and more valuable exit, as well as a more predictable and valuable hold period. Augie, I know you've lived here in the Seattle Metro for a long time. In fact, I think you grew up here. I think you're very well qualified to speak to some of the crime and safety concerns that some of the folks here might have.
Absolutely. I grew up in Phoenix Ridge neighborhood, which actually was not a bustling multi-million-dollar neighborhood. It was a discount or bread wheat store. It was crime-ridden, etc. And then over time, as the prices increase and more people move in with the neighborhood amenities, things like that, the area becomes quite nice and successful. And what we're seeing is with all those businesses coming back to Belltown, coming back to work, travel coming up, we're seeing that area improve. What really happens with crime is if an area is left to be on its own and people are not there actively in it in Seattle, that's where the transients go and we have lots of issues. So I do see that on the mend. I've seen it on the mend in the neighborhoods that we're invested in throughout Seattle. And I'm actually quite positive long-term that we will get things under control in our city. It is obviously something that is an issue in Seattle, but what we do get here is we get such a better tenant base that everything, more than compensates for it. And I also just want to say I really appreciate everyone who did come and listen to this webinar. I appreciate everyone who is listening to this webinar recorded. I'm very excited about this opportunity because I invest a lot in real estate. When I find a good multifamily like this that spins off cash flow, it's my number one rule. If you find something that is undervalued and it provides cash flow, that guarantees that when I put my money into this transaction, I'm going to get my money back. Not only that, but it's going to come with some of its friends in the form of distributions starting in year one, as well as a big payout once the economics turn. Then we resell that property once we cut the expense. So I'm very excited about this opportunity. I would love to speak to anyone else who has questions about it or my experience. Please do feel free to reach out to me after this recording. I'm an open book on my multifamily experience here in Seattle, and happy to share anything that you guys might want to know about.
Excellent. Well, I know we are at an hour's time. It doesn't look like there's any other open questions on it. So what we'll do from here is I'll send out the recording again to everybody that was on this, as well as the other folks that were unable to join, which will also include a link to the virtual deal room where you can learn how to invest in this deal, as well as learn more about the deal itself. Anything that maybe was not covered extensively in this webinar, as well as direct links to schedule one-on-one calls with myself. And again, the management team, Carl, Augie, and Dominic, would absolutely love to work with you, partner with you, and make money with you. So again, we thank you so much for your time, and we hope that you enjoy the rest of your evening. Thank you so much.